95% of traders lose money not because they can't find setups, but because they enter wrong, at the wrong place at the wrong time. Today, I'm going to be breaking down my top 3 SMC entry techniques that let me risk tiny amounts of money catching massive moves. By the end of this video, you will learn how to trade with sniper-like precision and outsmart the big boys on Wall Street. Like your entries will be so damn sharp, they won't even see you coming. And you might be wondering, how does Brett has any authority on speaking on this subject? Well, I've been trading for nearly 7 years, and this year alone, I've already crossed $1 million in trading profits, and every single trade is documented live on my second channel, Brett Trades. And on top of that, I've helped hundreds of students become 6-figure funded traders. By the way, we are the only mentorship program out there that has an endless scroll of student results. So I can tell you that my strategy works not just for me, but for hundreds of thousands of traders out there as well. So let's make it work for you. And here's my promise. If you stay until the end of this video, I'll review the one entry trigger that allow me to avoid 90% of the bad trades out there. Now, before we dive deep into the entry techniques, let's talk about why is it so important to get low risk entries in the first place. And let's take a look at a retail entry compared to an institutional entry. On a retail entry, what happens is that if you're trading retail concepts, you're going to enter for like a buy somewhere around here because price mitigated a support level or because you spot a specific candlestick pattern. In this case, is the Morningstar candlestick pattern or like the bullish engulfing candlestick pattern. And what happens is that you're going to be placing your stop loss below the candlestick pattern or below the support level. And your next take profit is going to be at the next support or resistance level. And if that happens, a lot of times you realize that you're at a very low risk to reward, right? What happens is that you're essentially risking 1% just to make back 1% or even less than 1%. But on the other hand, if you master the entry techniques, which I'm about to share with you today, what happens is that you're going to get sharper and more refined entries, and you are able to catch higher risk to reward, right? For example, this time around right here, we got price mitigating this order block. You enter for a sell here, you target this low right here, and then you place your stop loss above the order block. You can see this allows you to make back 5 times in terms of what you are risking, right? So if you're risking $100, you just make back $500. If you're risking $1,000, you just make back $500. And the reason why we try to optimize and refine every single entry is simple, because of the fact that losses are inevitable. If you think about it fundamentally, in trading, I cannot guarantee that you'll win, but I can guarantee that you're going to lose. So you better become a master at losing. And if losses are inevitable, what we want to do is to make sure that we are reducing the amount of money that we lose on every single trade. Because by doing that alone, we are automatically just going to make a lot more money in the markets, right? Because it's not about how many trades you win. It's about how much money you make when you are right compared to how much money you lose when you are wrong. How much money you actually lose when you get stopped out. Because that discrepancy allows you to become consistently profitable in the long run. So if you think about it, what we are trying to do here is just to make sure that we get outsized returns by ensuring that we keep our losses small and keep our wins big. And the only way we can do that is by refining our entries, by getting the best entries possible with the tightest stop loss and an unlimited upside, a huge upside. Alright, let's get right into it. The first and probably the most powerful entry technique is what I call the displacement trap entry. This is where 95% of traders get stopped out, right? This is where the market tends to be so-called manipulated. But instead of being the victim, moving forward, you're gonna learn how to be the victor. You're gonna learn how to play the game so that you can be the one that strike the retail noobs out there. And here's exactly how it works. So the first step is to identify the initial impulse candle that led to a break of structure. So in this particular case, we can identify that this is the bearish break of structure to the downside. And then later on, price comes down, pull back, give us another bearish break of structure, and then goes down, make a massive pullback, swap some liquidity right here before breaking structure and taking out this low right here. And if that's the case, this becomes our last internal lower high, all right? So if this is the last internal lower high, this is where the market shift is at, right? Because when price goes up there and take out the last internal lower high, it signals to us that in the short term, the market has shifted bearish to bullish. Once again, not to reverse, but to facilitate the pullback. All right, so that's the first step. We have identified that this is the entire impulse move that led to this break of structure. Now, here's where it gets tricky, because a lot of traders, when they see such a huge bullish momentum, they start feeling a fear of missing out. They start feeling like, oh my god, I need to get in for a buy right here. If not, I'm going to miss the move. And then if you enter for a buy right here, what happens next is that you're going to be placing a stop loss all the way below this low, because that's the price point that invalidates this trade ideal. So that's not optimal, right? Because if you enter for a buy right there and you place your stop loss below this low, what happens is that your take profit is going to be probably at the next supply zone, which is this area right here. And you can see it's not a good or intelligent risk to reward decision. It doesn't give you asymmetric returns. So in order for us to get the best entry, we need a tighter stop loss, right? Which means as much as possible, we want to enter somewhere around here so that we can have these huge upsides, right? Which brings us to the second step. You want to wait for some form of liquidation before you actually look for your entry. What happens next over here is that a lot of retail traders feeling the fear of missing out, they're going to start entering for a buy here. Or they're going to start entering for a buy anywhere here, right? When price starts pulling back, maybe they see a reaction over here and they start entering for a buy here, right? And then they get stopped out. And then later on, price continue to go down even further, right? Because right now, it's pulling back to the next point of interest that will allow price to actually explode to the upside again. So in this case, if I were to just quickly map out my demand zone, I'll see that there's a demand zone right here. And then there is also our extreme demand zone that we have down here. So like I said, the second step is to wait for some form of liquidation. So in this particular case, price is just consolidating right here, doing its pullback thing, right? There is no liquidation whatsoever. Let price do its thing, and you want to be very patient. Because like I said, this is where a lot of retail traders, they start entering for a buy. Like for example, they see price pulling back to this point of interest right here, and then they enter for a buy here or enter for a buy here, and they justify it by saying that this is indeed a liquidity sweep. Yes, true to a certain extent, but what they fail to realize is that there haven't been the third step, the third criteria, which is a break of structure, again to confirm that this internal structure is shifting bullish, right? So now the internal structure is aligned with the higher time frame structure. The internal structure is aligned with the swing structure. And if that's not present, right, then we don't have confirmation. And if we don't have confirmation, we do not enter whatsoever. This is how we protect our capital, right? Really preserving our capital for the trade setups that has a high probability of working out. So if that's the case, I'm being very patient right here. I don't care what price does until price actually breaks some form of structure after it liquidated some form of low, right? So you can see price continue going down right here, consolidating, go down even further. And if you look at the candlesticks clearly, you will start to see that it start to lose momentum, right? The candlesticks start getting smaller and smaller. The lower wicks start getting longer and longer. And what this signal to us is there's buying pressure in the market. There's bulls in the market about to jump in and actually cause price to head up right now. Very, very soon, right? But not yet, right? Like I said, that is where you want to be very patient, right? You want to wait for the liquidation. You want to wait for the break of structure. So in this particular case, if we continue to map out this internal structure, or rather the internal structure, what happens is that if you look at this was that last internal break of structure. This is the next internal break of structure. And then later on price pulls back, goes down, and you can see this is the next internal break of structure, right? So price is technically still bearish. So I'm not going to rush to enter for a long position right now, right? Until price actually break out of the last lower high, which in this case is this one right here, right? Once price break off this last lower high, it confirmed to us that this pullback is over, and right now the internal structure on the lower time frame has shifted bullish and is going to continue with this bullish momentum that we have established a few hours ago, right? So if that's the case, let me just map the market shift up again, and I'll mark this as a market shift right there, and that will be the third step, right? Which is you only enter after you got a confirmation in terms of a shift of structure and after a liquidity sweep, right? And speaking about the liquidity sweep, I almost forgot to mark up the second step, which is to identify the liquidity sweep that caused this market shift in the first place. And if you look towards the left hand side, what we have was price goes down, pulls back, goes down, pulls back. And when this happens, this induces retail traders to actually enter for long positions early, right? They enter for a buy here, place their stop loss below these lows. So that is automatically generating liquidity for us, the professionals, right? The professional gamblers. So what happens is that price sweep all of this good old juicy liquidity from this low, right? Mitigate this extreme demand zone that we have marked up right here, led to a market shift over here, There we have it. All 3 steps have been completed. And that, my friend, is the displacement trap entry. Because when you enter right here, you are no longer rushing to trade. You are no longer getting a sense of fear of missing out and you enter for a buy right here. No, you are waiting very patiently for price to get your ideal price point right at the right place, and you're entering at the right time because you are waiting for further confirmation in terms of a shift of structure. And now you are trading in alignment with the internal order flow. And now what happens is that, let's say you enter for a buy somewhere around here, you can place your stop loss easily below this low here, or even place it below this point of interest if you want to be conservative. And then you can just target like 3R, right? Or even 2R, just to keep it mechanical. So in this particular case, you probably want to target like this next supply that we have marked up right here, right? Because this is also like supply zone that led to a huge amount of imbalance, which is the order block, which we're going to cover later. But this is where you can target this high, or like I said, you can just put it to like fixed take profit of like 3R. Maybe something like this. Honestly, this is not really the ideal entry, but let's look at what's going to happen next. Boom! Price stopped you out. Oh my god, no, the entry model doesn't work. Brad, this entry model is fake. This entry model is a scam. Alright, I purposely showed you guys this example because once again, this is where so many traders are going to make a mistake when they are using this entry model, right? They enter for a buy right here, not knowing that there is more available liquidity that needs to be swept before price actually moves to the upside, right? So this, my friend, is the displacement trap, right? The displacement trap happens when price comes down and sweep more available liquidity before pushing to the upside, right? So what happens is that over here, price comes down, pulls back, right? Create like a market shift right here. But when in reality, if you look at it, what happens is that price is actually pulling back to this previous supply that we have right here, right? It's pulling back to this previous supply, and not only that, it's also sweeping all the available liquidity above these highs right here, right? And this, my friend, is where so many retail traders, when they don't listen to clear instructions, right, they use this entry model, they enter for a buy right here, and then they get stopped out, and then they think that this entry model is a bullshit entry model that I pull out of my ass. When in reality, you still don't understand how the game is played, right? Because what happens over here is that this is just smart money using more available liquidity to push price down even further, right? To get like a final liquidity sweep before the real move actually happens, before the institutions can actually join and cause price to move to the upside, right? Because it needs to really sweep all the available liquidity before they can actually start pumping money into the market, right? Before they have sufficient liquidity to fuel price to the upside. Well, if that's the case, how do you prevent this situation from happening? Well, instead of entering on a liquidity sweep, an ordinary liquidity sweep, you only want to enter after the final liquidity sweep. And how do you spot the final liquidity sweep? Well, you look for the leg that closes past the imbalance, right? So if you look at the left hand side, what we have over here is that there's a large amount of imbalance, right? Imbalance is defined as the gap that is formed when price actually has this huge move to the upside, right? You can see this gap right here between the high of this previous candle and the low of this previous candle. So this is your imbalance. So what we want to do is to wait for price to blow right past this imbalance, right? We want to wait for price to actually sweep all of this imbalance right here, right? You can see in this particular case, price goes down, sweep all the imbalance that we have on the left hand side, filling up the imbalance, and then later on it come down, sweep the liquidity below the low of the imbalance before pushing to the upside. This is the last time that price has swept liquidity and is about to have a huge move to the upside, right? So step 1, look for the impulse candle that led to the break of structure. Step 2 is to wait for some form of liquidation. And if you want to be even more cautious, you want to wait for price to fill up the imbalance that we have on the left hand side and swap the liquidity of that low before you move on to the step 3, which is, as usual, just look for that final confirmation in terms of a market shift, in terms of a break of structure to the upside, right? So in this case, since this is the most recent internal break of structure right here, this will be the last lower high that we want to see get broken, right? So that's the last lower high. So now, all I have to do is to wait for price to take out that high to prove to me that smart money has indeed used the available liquidity below this low right here, the displacement, the imbalance, And right now, we're about to push to the upside. And that's exactly what price gave us over here. So this is where you can easily enter for a long position right here. Place your stop loss below this low right here. This low will be counted as protected because it has obviously swept liquidity from this low right here. So price is less likely going to pull back all the way down here, sweep more liquidity before it actually goes up, right? So that's a place that you can put your stop loss safely without worrying about getting stopped out before the real move actually happens. And then this is where I can try to target the next supply zone that we have up here, right? Or if you want to be even more precise, you could have easily entered on the 5-minute time frame, on the lower time frame, when you already got a fractal market shift right here to confirm to you that price is actually going up. And then you can also place your stop loss below this new candlestick right here, below this pivot candle over here of the pullback. And then you can place your take profit at like 1:3R, right? Something like this. Or you can just target like the next supply zone that we have on the 5-minute time frame, which is this area right here. So once again, there is a few method you can use to manage your trade, right? But to keep it simple, keep it mechanical, in this particular video, I'm just going to use the 1:3R method, right? Which is just like this, right? Just place it fixed at 3R and then place your stop loss either below the last pivot candle, right? The last pullback that led to this imbalance right here, or below like this protected candle that we have down here, right? But in this case, let's just see how this plays out first, right? Price goes up, right? Because now it has fuel, now it has momentum, now it has this bullish demand that will actually cause price to go up because it has swept all the available liquidity that we have on the left hand side right here. Okay, this is a bit slow. Let me just like pump it up, right? Boom, outsized returns right there, baby. Outsized returns, as simple as that. All right, I just realized I spent way too much time on the first entry technique, right? But I just really wanted to go super duper in-depth as much as possible and provide you guys with as much value as possible so that you can really understand how to implement each entry model in live market conditions. But anyways, let's move on to the next entry technique, which is the refined order block entry. First of all, what is an order block? What defines as an order block? How do you spot an order block? Well, an order block is basically a point of interest that led to a large amount of imbalance, right? It's the point of interest where institutions enter for buy or sell orders in bulk, right? And that is what generates this imbalance right here, right? This huge selling pressure, this big bearish candle, right? Big bearish candle, BBC, right? That's what creates the BBC, the big bearish candle. And in order to help you spot order blocks, I've created this acronym called BASIL. BASIL basically stands for B, break of structure, A, alignment with trend, S, sweep of liquidity, I, imbalance, and L, last candle, right? The more confluences this order block has, right, which means the more of this criteria it has checked off, the stronger the order block becomes and the more likely price will react from it and continue even further. So in this case, since we are on the 1 hour time frame, we have defined that this is the order block because this is the supply zone, right, that led to this huge amount of imbalance in price, right, this big bearish candle. And it also led to a break of structure on the lower time frame, and it's also aligned with like this bearish internal structure that we have going on right here. And it has also swept some liquidity above these highs over here. And most importantly, it gave us a huge amount of imbalance right here, right? You can see this big bearish candle, clear as day, institutional selling pressure. And L is pretty much the last candle, right? That is how you identify the order block. It's the last candle before the big bearish candle or the big bullish candle, right? That's it. Now, obviously, we don't want to enter on the 1 hour time frame unless you are a swing trader, right? If you're a day trader, you're a scalper trying to trade with precision, try to get tight stop loss, you want to make sure that you enter on either the 15-minute time frame or the 5-minute time frame, right? But I'm drawing the order block on the 1 hour time frame just to show you guys how wide of the initial order block looks like, right? You can see it's quite wide. If you enter for a sell right here, your stop loss will be at least like 21 pips, right? And that's not ideal for us, right? If you are trying to really catch this asymmetric risk to reward trades, right? We want to keep it tight, like 5 to 10 pips tight, right? So what happens is that you want to drop down to the 15-minute time frame and you want to continue mapping any sort of refined order block, right? Refined is considered as a tighter zone, right? That's all it is. It's just a tighter zone. So in this case, this is the 1 hour order block, right, that we have marked up. And a refined order block will be point of interest within this gigantic order block, right? So if I look at this move right here, what happens is that price goes up, right, creates imbalance, right, pulls back and then goes down, right, and then pulls back and then goes down even further, right? So just by doing that alone, I can spot that this is my most obvious order block, right? This is the last candle that led to a huge amount of imbalance. You can see this huge gap right here, right? This large amount of imbalance. So clear as day, this is an institutional price point where we can expect some form of selling pressure to cause price to go down even further. And this is where we want to enter for our sell, right? Upon the mitigation of this zone, right? And on top of this, you can also see that there is this extreme zone, right? That led to this imbalance right here. That led to this huge selling pressure, right? So I will mark that out as the extreme zone as well. You basically want to identify, once again, the last candle, right? That led to the big bearish candlestick right here, and that will be your order block. In this particular case, since there's not much imbalance, right? You can see the previous candle closed right here. You can see the previous candle low is over here, and then the next candle low is like, and then the next candle high is like over here, right? So there's actually not much imbalance. So this wouldn't really be like an order block. Technically, it would be more of like an ordinary supply zone, right? So I'll identify this as a refined supply zone, and then this as a refined order block. All right, both zones has a high chance of working out, right? Because it led to a huge amount of selling pressure, right? So we know that there is going to be sellers sitting at this price point right here, waiting to push price down the next time price actually comes up to that area. So quite simple. In order for you to use this entry model, identify the imbalance in price, identify the order block that checks off this criteria right here, and then just wait for price to mitigate one of those order blocks, and then just make your entry from there, right? So in this particular case, once again, let's practice patience and let's just wait, sit on our hands and not do anything until price mitigate any more of this refined order block, right? So what happens over here, price came up there, mitigated our first refined supply zone, right? The moment it mitigated, you should be in. You should be entering for a sell. So in this particular example, you'll probably be much better off placing like a sell limit order at the edge of the zone itself, right? Potentially just right here. So once price gets to that area, you are automatically tapped into the position and you place your stop loss above like this order block right here, and you place your take profit at 3R, like somewhere around here, right? As simple as that. All right, so if you want to catch these refined entries, refined order blocks entries, bear in mind that you want to make sure that you're using sell and limit orders, right? Which is pretty much just pending orders so that you can get in at the best price point, right? And bear in mind that this type of entry is a lot more aggressive, right? Because you're not looking for any sort of confirmation, which means that there is a chance that price is just going to blast right through the order block and just disrespect it, right? So this is a lot more aggressive, right? So just take note of that. So you can see in this case, you got tapped into the trade, stop loss above the order block, and let's see whether price hit your TP. Boom, smash your TP, as simple as that, right? I personally, I'm a much more professional, so I would place my take profit at this low right here, right? The next swing low. And you can see this would be like a 5R trade. This position has hit take profit. Let's look at what's going to happen next, right? Because price has not actually came up to our extreme zone, right? And you can see, let's move back a little bit further, right? Price comes up there, hit our extreme zone, and this is where if you actually place like a, once again, a limit, sell limit order right here, and you place your stop loss above the zone, you place your take profit at 3R, you can see easy take profit again, right? You smash take profit twice in a row, all by using this simplified approach of identifying order blocks and entering upon the mitigation of the refined order block, right? And you can see our stop loss is usually like 6 pips, 7.5 pips, like less than 10 pips stop loss, right? So it's a very good way for you to trade with sniper-like precision. But like I said, it's super duper aggressive. And bear in mind that the reason why this move moves so fast is also the fact that price has just swept the liquidity that we have generated above this previous high that we have right here, right? It swept this liquidity right here, stopped out all the retail traders who enter for a sell right here but haven't take profit yet, and then for the real move to actually happen to the downside. Once again, the reason why we actually mark up the order block on the lower time frame, i.e. the 15-minute, the 5-minute time frame, is because we want to get the tighter stop loss possible, right? Because we are always going to be placing our stop loss above the order block or below the order block if you're entering for a buy. So, which means that if you're on a tight stop loss, your order block needs to be tight as well, right? And obviously, we don't really draw it on the 1-minute time frame because 1-minute order blocks are extremely unpredictable and unreliable. A lot of time price will just blast right through it because there's a lot of noise on the 1-minute time frame. So I will highly advise you to withdraw your order block, right? Your refined order blocks, the 5-minute time frame or the 1-hour time frame if you are swing trading. So third entry technique is kind of like an underrated one that not a lot of traders know about, and that is the breaker block entry. What is a breaker block? A breaker block is simply a failed order block. It is formed when price fails to respect an order block, bullish or bearish, and instead closes strongly through it, right? So in this particular case, this is the order block that we have identified that fulfills the Basel criteria, BASIL. And what happens is that if this order block fails, right, which means price blasts right through it, this automatically becomes a breaker block. And that broken order block often flips into a new point of interest in the opposite direction because the liquidity resting there has been absorbed. All the liquidity right here, all the selling pressure over here has been absorbed. And now, the next time around, price actually come back down to respect this failed order block. It becomes a breaker block, which means that there is going to be demand at this price point, right, to push price up, right? There's going to be buyers at this price point to push price up. So if you're talking about retail concepts, this will be your resistance level that has become a support level and a broken support level that has turned into a resistance level, right? But in SMC terms, it's basically a broken order block, a failed order block turns into a breaker block. So this entry model is kind of like tied to the previous entry model, right, which is the refined order block entry. So in this particular case, the first step is to always identify the order block, right? And you can see this is clear as day, a bearish order block. So if price is mitigating the order block, obviously we want to enter for a sell right here, right? We want to enter for a sell on the mitigation of the order block. But look at what happens next, right? We get a reaction, right? We get a small reaction and then boom, huge demand step into the market and cause price to push up. And this could be because of news, right? Yeah, this could be because of news or because, yeah, this is actually because of news because it's around 8 p.m., right? So this is definitely because of news. So if you're using the previous entry model, right, the aggressive refined entry model, what happens is that you can enter for a sell right here, but it can get stopped out because you are not looking for confirmation. You're not looking for extra confirmation that price is going to hold at that price point. So that's the downside of using entry model number 2. Right? But then what happens in this case? If you use entry model number 2 on this case, right, and you fail, right, you get stopped out right here, what happens is that you can shift the way you perceive the markets by thinking that, okay, this order block has failed. It's not bad, right? It's not good. It's not a bad situation. It just is. Price is just doing the thing it's doing. It's just moving. So what you want to do is to really reframe the way you perceive the markets by thinking that, okay, now this order block has failed. Where is the next opportunity that I can actually enter for a buy or a sell, right? And since this order block has failed, it's most likely going to be turned into a breaker block, right? So the next time price actually come down and mitigate this order block, this failed order block, which I got stopped out from, unfortunately, I can just easily enter for a buy right here to capitalize on this move to the upside, right? So now it's a matter of patience again, right? We wait for price, mitigate that little breaker block. Once it does, same thing, enter for a buy somewhere around here, right? Place your stop loss below the breaker block, target 2R, 3R, whatever. Let's just put it like 3R, right? And you can see what happens next, right? Let's see whether price respect this breaker block. Okay, you respect this breaker block, slowly start trickling up, and then boom, smash your TP. As simple as that, right? And what happens is that you are able to win this trade right here. You win 3R on this trade. Oops, that's an ugly trade. You win 3R on this trade, and then you got stopped out for 1R on this trade right here, right? When you use the previous entry model. And now, because you are stopped out on 1R, right, you lost 1%. And now because you have adapted to the market quickly, what happens is that you just make 3R, you just make 3%, right? So overall, you took 2 trades, you're up 2%. This is why it's so important for you guys to really understand how these entry techniques work, so you can really stay profitable in the long run. Alright, so those are the 3 entry techniques. And just like I promised, if you watch to the end of this video, I'm gonna show you a live trade example on me actually applying these entry models, and also how I actually enter the right trade at the right place at the right time using what I call the session timing filter. Alright, so first of all, let's just go through the entire live trade example. Right, so what happened was that last week, I actually entered for a buy somewhere around here because of the first entry model, right? The first entry technique, which is the displacement trap entry technique. And this is pretty much the exact same example that I just showed you guys earlier on, right? What happened was that I waited for the market shift right here, right? This was the impulse up, and I waited for price to sweep all the available liquidity right here, right below the impulse candle right here. And then what happens is that I entered somewhere around here, which is a little bit aggressive because I did not wait for like this market shift right here. But because I've been trading for so long, I kind of know where the market is going to head towards, what the market is going to do once price actually sweep out this low, right? So I kind of forgo like the third step, right? Which is necessary if you're starting out and if you don't have experience, right? Like I always say, I've earned the right to be discretion, right? A little bit discretion when it comes to the way I execute my trades. But I'm always following a rule-based mechanical set of criteria before I actually enter for the trade, right? So over here, enter for a buy right here, pretty much place my take profit at this area here. I ended up getting out somewhere around here because this was like a few minutes before news, right? If you guys watch the live trade breakdown on my second channel, you will see that I was kind of pissed off because I got out somewhere around here, and then news came out and price actually went up there and smashed my TP. But the reason I got out is because like I really do not want to risk this extra 10 pips, right? Just risk catching this extra pips just so that I could, you know, potentially get this entire position start reversing against me if the news doesn't play out the way I want it to play out, right? So I was like, you know what, I'm just not gonna risk it for the biscuit. So I just got out like somewhere around here before the news actually released. Now, that is the first entry technique, right? But what happened over here was that when this actually happens, this becomes what? Your refined order block, right? This is actually a refined order block. This is actually the 15-minute order block that led to this huge amount of imbalance to the upside. So what you can have easily done is wait for price to pull back to this order block, place your buy order right at the edge of the zone, place your stop loss below the zone, and then just target like 3R just like this, right? Simple 3R, as simple as that. If you zoom in right here, you can actually spot our third entry technique, which is the breaker block. You can see this right here is a clear as day order block since there's a lot of imbalance right here. And then what happened later on was that price actually went up there and smashed right through it, right? You can see first it reacted from there, right? But the second time around, you actually smashed right through it. And when this actually happens, this order block, this bearish order block becomes a breaker block. So the next time price actually came down to mitigate this breaker block right here, what happened was that it came down, mitigated this breaker block, easily entered for like a buy somewhere around here, place your stop loss below the breaker block or below like this candle right here, target 3R, you can see easily could have smashed your TP fast as well, right? So this is more of like a quick little scalp. So yeah, you can pretty much see like these three entry techniques is like universal, yes, stood the test of time, and I can assure you that this works, right? Because it not just worked for me, but for, once again, hundreds and thousands of traders that I mentored personally. Now, here's the bonus tip. You want to make sure that you are trading at the right time. The right time matters the most. If you're trading at the right setup at the wrong time, you will not see price moving to your TP as fast as you want. You will see price moving very, very slow to your TP because the market is lacks volatility, or it can even go against you, even though your entry model is right, but because your timing is wrong. So how do you trade during the right time? Well, you master what is called Q zones, right? This right here is the best time to trade. For Asian session, this is the best time to trade. For London session, this is the best time to trade. For New York session, this is the best time to trade. And for London close, this is the best time to trade. And all of this is in the Eastern Standard Time. And you want to make sure that you are matching the currency pairs that you are trading to the time that you want to be trading. So for example, if you are used to trading the London session because that's the time zone where you are free to trade after your 9-to-5 job, or after you have put aside all your obligations like your kids, whatever, that's your only free time. Then during the London session, you want to trade during the London Q zone, and you want to be trading these currency pairs that tends to provide you with the most amount of opportunities during the London Q zone, right? Which is Euro and GBP pairs, right? This is where you get high trading volume. You can catch 20 to 50 pips, right? So I'm giving you this secret sauce right here. Screenshot it, right? Put it as a bloody wallpaper. Print it out and put it on your desk if you need to, but just know that you want to be trading during this timing alone, right? And in this particular live trade, what happened was that I actually entered for a buy here somewhere during the London Q zone, right? Towards the end of the London Q zone itself. And that is exactly why right after I entered for a buy, price just pushed to the upside, right? You can see there's a lot of liquidity pushing price to the upside immediately after I entered for a buy. Not because I got lucky, but because I was at the right place at the right time so that I can capitalize on the luck. That's what trading is, right? It's about increasing the likelihood of success by putting luck on your side, right? By ensuring that once again, you are maximizing all the variables that is within your control so that you can actually increase the probability of you winning the trade, right? Because it's not a game of certainty, it's a game of probabilities. So you might as well focus on managing your risk well, right? Executing your edge well, and really focus on the things that is within your control, which is your entry, which is your exit, which is your risk to reward, which is what time you are trading, what currency pairs you are trading, and what are the mechanical rules that you follow on like a daily basis, and what risks are you deploying on each trade. So these are pretty much the best low risk SMC entry techniques, secret sauce entry models that a millionaire trader like myself have used, right, to scale to 6 and 7 figures. So I can tell you that it works. It's the displacement trap entry model, the refined order block, and the breaker block entry model. Use them and you will be able to cut your losers in half, and you'll be able to 10x your profits or even 100x your profits. Okay, so if you're in the US, UK, Singapore, Europe, Australia, and you are serious about scaling your trading profits, hit on the subscribe button right now. Because every single week, I share the exact strategies, routine, and entries that have built me consistent 6-figure months. And just click on like the notification bell little button that we have down there if you want to get notified every single time I drop like a high value educational trading video just like this one. And if you're ready to take this further, my mentorship has helped hundreds of traders go from struggling, inconsistent, lost, overwhelmed to becoming profitable, confident, 6-figure funded traders in less than 6 months, right? 6 to 12 months. That's the usual timeline. We take them from struggling to becoming a profitable and consistent and confident trader with a profitable edge. If you want, link is in the description. And if you have enjoyed this video, make sure to check out this one next, right? Because in this one, I dropped way too much sauce, right? I gave you too much information, right? Like I should be asking you to pay for this shit, but I'm giving it to you for free, all right? Most trading gurus will charge $50,000 for this, but you get it for free, all right? Just go and check it out, right? There's nothing for you to lose. And as always, remember, you are just one trade away.